Normal's hard. I mean, everyone's going to have different views over different time horizons. From our perspective, we tend to think that it wouldn't be unusual to see at least a few percent increase in interest rates in the US over a medium to long-term time period. I think that the historical numbers have been influenced quite considerably by the very, very low interest rates that we've had over the last sort of 5 to 7 years. And so I think, like you say, people have got used to that idea that rates are close to zero, and so when they think about where they could go to, I think there's perhaps a leaning towards a mild increase in rates, but in reality we're a long way from, I think, what the longer term history will tell you is normal. On top of that, you've then got the situation where you've had so much stimulation in particularly, say, the US economy, for example, over the last kind of 7 years, whereby you're now in a situation where the US could actually perform from a growth perspective quite, above average, or quite well above average, over the next few years, on the basis that you've had this huge block of stimulation come through in this very stimulatory environment where it's been very cheap to borrow money. Jobs are being created hand over fist, and so productivity in the US is likely to be pretty strong over the medium to longer term. If you get that sort of environment, then rates could easily go up a few percent or so, and that's just a product of the part of the cycle that we're in.